All right, welcome to the March 10th meeting of the Water and Sewer Commission. And we can get right to it today. There's no, I guess if there's any public comment from anyone. But if there's no public comment, we can get right to the meat of our meeting. Are you starting?
So I think what we'll probably do is maybe we'll go right to Samantha and Heather from RHR and have them take us through the pertinent parts of the audit for water and sewer. I think that might be a good way to kick things off. So who's gonna start, Heather or Samantha? I think there's Heather.
I think Sam is going to start with this piece.
Yep.
Would you let me pull the audit up and share it so that I can go to different pages? Does that work for you? If there's pages you want to reference?
If you want to do that, or I can share my screen, whichever is going to be easier for you.
What's easier for you? Because it doesn't matter to me.
Probably if I share my screen, if that's okay.
Makes a lot of sense. Let me just give you that power. You should be good to go.
All right. Now let's make sure I open the right screen. Okay. Can everyone see this okay?
Yes.
Yes.
Okay. All right. So, as Josh said, my name is Samantha Ruggles, and I'm joined by Heather Hunter, who's our Director of Audit. And we're just going to kind of take you through the highlights of the water and sewer portion of the 24 audit. I know that there's been kind of some questions about how we present these funds on our financial statements. So I think I will, if there's questions while I'm talking, feel free to interrupt me, and Heather and I can answer the questions as best as we can. But I will start by saying that if you've ever looked at a set of financial statements, you'll notice that, the general fund and any sort of special revenue funds are presented in a specific way, but then water and sewer, which we would consider enterprise funds, which are what you would call like self-sustaining funds. They're business type, they're run like a business or like a for-profit entity. The requirements on their presentation is a little bit different. So what I mean by that is they require, capital assets, long-term obligations, and I'm forgetting one. No, I'm not.
A full accounts receivable.
Thank you. To be presented on their actual balance sheet. So with that being said, I will start here, which is on page 24 of the actual audit. And this, if you'll see right here, you'll see the net position as of July 1. You will see that it is restated primarily due to the capital asset corrections. So we had to do some adjusting to make sure that the capital assets in the water and sewer fund were accurate and the depreciation was accurate. So that is resulting in this capital asset correction and ultimately a restatement, which is just a correction to a prior balance on your financial statements. For your water fund, you guys brought in for operating revenue about $384,000. And for operating expenses, you guys spent about $316,000, which left you, or which had a net change about $27,000 in your net position. For sewer, you guys brought in for operating revenue about $802,000, and for operating expenses, it was about $1,065,000, which decreased your net position by about $263,000. Your ending net position for your water is about $2,500,000, and your ending net position for your sewer is about $4.2 million. If we scroll up, this breaks down all of your liabilities. As you'll see, your bonds payable and your current liabilities. So your current liabilities are anything that is due within 1 year. So from July 1 to June 30, that is all going to be here. This is what's due within that time frame. Anything under here is anything that is due beyond 1 year. So you'll see your bonds payable, which some of them are 30-year loans, 15-year loans. The balances of those will be down here. Net pension liability is for your pension and your GASB and your VEMRs. And then we scroll up, we'll see, your accounts receivable, and then your capital assets and your depreciation. One of the things that I want to note on here and kind of talk through is the net position. So as I mentioned, for water, the total net position at the end of the year was, oh, someone have a question? Okay. Your total net position for water was about 2.5 million. We break that out into certain aspects. So the total amount that is invested in capital assets. So this is a formula that is based on your total capital asset cost, less your depreciation, and less your bonds or notes payable that are paying for those assets. So that is broken out. So I think, Heather, you've explained it before that you would have to start selling these off in order to earn that money back. Correct, Heather? Am I explaining that correctly?
Yes, that's the correct way to equate that.
Okay. Restricted is what is restricted in your, I believe, capital projects and what your capital reserve for those funds.
Can you hold 1 second? So Jay
Yep.
had a question. So yeah, basically all that money is the value of all of the equipment that we have essentially.
Yeah, the plant, the sewer lines, the water lines, the pump house. That's what we're talking about. Things we could never ever sell.
Right.
Right. So
Trucks and
It does include things like trucks.
the spare parts. I don't know if you count those up and give a value to them.
Yeah, I don't know how granular you get. Probably larger capital items is included in that, right? Like you're not counting wrenches, but you are counting a pickup truck.
usually our capital asset threshold is anything that is over $5,000.
Okay.
Unless you guys have, which I don't believe you guys have, a capitalization policy that it would exceed that 5,000.
If something is still being paid for, like on a loan or a bond, do you count that in your capital assets, or do you wait until it is paid off
Good
for it
question.
to hit the capital
Nope.
assets line?
Nope, we add it right when you guys acquire the piece of property.
But did I hear you correctly say that you subtract out the amount that's due? So if we buy $100,000 piece of equipment, we still owe $90,000 on it. That only contributes 10,000 to the net position.
But
Correct.
there's depreciation also.
And then you have to factor in depreciation.
Correct.
So maybe it only contributes $9,000, but it's basically the full value minus depreciation minus what's left in the loan on that. And that's what you get. It goes into that net position line on any piece of equipment.
Correct.
All right, cool. I think we're getting it.
Okay.
All right. So that is the number. That's what makes up this net investment of capital assets. The restricted value is your capital reserve, which is calculated, I believe, by Connie, where that portion of money is reserved for capital purchases in the next year or in coming years. And then your unrestricted
Sorry, let me
is-
Samantha,
Yep.
let me jump in real quick. So to kind of put that in terms, I think the commission will understand. So when we look at our water and wastewater, we look at 3 reserve funds essentially, right? You guys are familiar with those. So those 3 reserve funds, the total of them is what ends up in that restricted money. So that's money that is on hand, but it's restricted to those 3 purposes and to those 3 accounts.
Okay. I seem to be missing the raise hand button here in my Zoom, but I had one other question.
Sure.
Up at the top of the page where we have due to other funds, the 839,788, is that just moving between water and sewer like we always do, or is there? Because I don't see the counterbalancing. Where would I see the counterbalancing number of that money being received if it was going into sewer? It's probably staring me in the face, but
Nope,
Where-
and so the way that it works is it is in if you were to look at the trial balance, which is what we look at, all of those, it's basically saying that somewhere in here, whether it's most likely the general fund, paid something on behalf of the water and the water was paying it back for it. So it might not be between water and sewer, it might be between the general fund.
But
Oh, if
isn't there also on the sewer line, there's a due from other funds line, I think on the page,
That's what I'm thinking.
maybe up.
Yes,
Yep.
It's not, yeah, so there you go.
Yes, so it does counteract, but I don't think it's exact.
It's not because.
No,
like,
No.
there's
Right.
fire protection money coming. Well, actually, that's water.
It would be like a payroll expense that
Right.
the water and sewer owes back to the general fund.
Right.
It all comes out of water. So like water fund would have to pay the general fund and then have to pay back sewer for their piece of it.
I'm hip. Okay.
Yeah, it gets a little confusing because water owes sewer money and then water also owes the general fund money. If that,
There are times I wish audits were hyperlinked so you could click
oh yeah.
and see the corresponding number in another part of this.
But no, but that's a good, I had the same question as far as like, how do those line up? And I think that hopefully helps answer it.
Mhm.
Thank you, Samantha. Sorry to keep jumping.
No,
in.
that's fine.
I do have a quick question. So
Sure.
this is more like accrual accounting than cash,
Exactly.
right?
Yep. That's exactly
Because
what it is.
the accounts receivable is what we have billed out, not what we have been paid, correct?
Correct.
exactly correct. Yeah.
Okay.
Yep. And then you'll see if you scroll down to the statement of revenues and expenses. So this charges for services. This might include a couple, like one or two different lines, but this is primarily what has been billed out for water and sewer as of June 30th, 24. Go ahead, Jay.
Because we don't meter sewer, people are getting basically whatever you use for water, we're assuming you're using exactly the amount of sewer and then you pay those rates.
Yep.
But does that sewer amount their charges for services include septage?
Yes. Yep, it does.
Okay.
Because we don't break out septage separately. I think it's all in one fund on your financial software.
Okay.
And I think this, does this correct for the bills that go out in July? Does it back those this backs those bills up? So this is true usage and bills for quarter 1, 2, 3, and 4 in 24, even though we don't bill that until the next fiscal year. Because we make that
Correct.
adjustment later in August to back it in.
Barb?
Correct.
Connie can tell us what our septage revenues have been
Yes.
year to date.
Yeah.
So even if it's blended here, and this illustrates a deeper point, putting aside the audit, there are questions and concerns about tracking revenues and expenses in real time during the course of the year in managing the budget. So that's foreshadowing after this conversation or explanation of the audit.
Just because it's on my mind and you would know the answer to this, I don't know if percentage is the right word, but like what percentage do you feel like remains unpaid of what you bill out quarterly?
So that's where we get into having to do some adjusting. So what we build actually relates to our revenue line. And the reason we do it that way is because we will collect every penny of that. So we count the full amount as revenue.
Yeah.
What you see in the accounts receivable line is what is left that people owe us.
Okay.
But our fiscal years overlap at both ends.
Yeah.
So we have to do an adjustment at the end of the fiscal year to account for example, in July, we're billing for the prior fiscal year.
Right.
We're not going to collect all that until it's due September 30th.
Right. And I guess I was just wondering from a just curiosity, separate from this, do you have many people that don't end up paying their bills or does everyone come current?
Or we
at
shut
some
them off
point?
eventually.
Yeah.
Right. Well, in the septage, I was wondering too, if everybody.
So about 6 years ago, we updated our delinquent account policy.
Yeah.
And we adhere to it. We treat everybody equally, fairly. And I can say right now, the only amount that's in delinquent is about $400 something.
Okay. That's good to hear.
It's very good.
And when we get into the quarterly reports, Connie always puts an extra sheet in there. So for instance, I'm looking at quarter three here or quarter two from this current fiscal year. So on October 1st, it was $15,000 outstanding. By October 31st, it went down to $3,000. On November 30th, it was $141. And on December 31st, it was $9. And we give that to you guys quarterly.
Yeah.
So you can see like what's still outstanding and I think we started doing it to be like, well, is there a problem with people paying back? Is there a hardship? And they always go down to like less than $100 at the end of the.
We do payment agreements.
Yeah.
And once people got over the stigmatism of that and realized that, hey, we're just here to help.
Yeah.
Your neighbors were not here to stigmatize you.
Exactly. Once we got to that and consistently did it,
It was,
people they'll like call me ahead of time. I really don't think I can make a payment that by this
eight.
Wednesday, can I do a 2-month agreement?
Okay, good.
Great. Back to you, Samantha.
Okay, back to you.
No worries. I mean, it's kind of a broken record between water and sewer because they are treated the exact same way. But just to kind of highlight for sewer, so your net investment in capital assets for sewer is about 3.4 million. And again, that includes all your capital assets. I believe you guys had some additions to your capital assets and your distribution centers there this year. I want to say it was like 160,000, but I don't know the exact total.
So that was the press repairs, the $160,000 that we spent in FY24 for the press repairs. So we got a bunch of new pieces. Remember, the press was like going to die,
Yeah.
and we ordered those pieces really quickly. So that 150,000 is the assets from FY24 that he was talking about. I can't remember if the truck was 24,
It
25.
was
It
22
would
or
be-
so. It wasn't a
It was
lot.
just this past summer. It was
Yeah,
like
yeah.
$20,000.
Right.
But yes, that would also be another asset. But I think for the FY24, which is what we're looking at here, the big one was the additional pieces for the press.
And then your restricted is about 474,000, and then your unrestricted, and I didn't highlight this in your water, but you're unrestricted for both water and sewer. So this is what is left after you take out everything that's invested in capital assets and then anything that is restricted. So these numbers right here is what you have available for use towards a budget to move into do more capital improvements, things like that. So this is really the number that a lot of people want to see over anything else. But yeah, so that is where you guys stand right now. And I will just give Heather the opportunity if she wants to say anything.
Real quick, again, dumb question as a non-accountant. You probably
No, it's okay.
just I zoned out. What is the difference between restricted? I know what restricted and unrestricted is in the town budgets, highway and everything else, but what is restricted and unrestricted here?
It follows the same rules.
Yeah,
So your restricted are ones that you voted on and the town has voted on to be able to set aside funds. Unrestricted are those available to, do, assignments of funds or do further restrictions at an appointment vote for those funds.
Restricted are reserve funds.
Okay.
The three reserve funds in each water and wastewater. And then unrestricted is essentially unassigned funds from the general.
Okay.
Was there something with the restricted that like other departments could potentially dip into that or no? That's the general town.
That's the,
budget.
yeah,
Okay.
so in
Forget I
general,
asked that.
in general town, unassigned funds can go to any department.
Okay,
Restricted in the town budget is restricted to highway use only.
okay, that's what it
In
was.
this instance, restricted is restricted to those three reserve funds that we have. And we also detail those out separately when we get into the budget process. And then unrestricted can be used for anything water or anything sewer, but they can't cross from water to sewer. They have to stay. So in that sense, yes, they have to stay in their lanes and in their departments.
Okay. All right. Samantha or Heather? I don't remember who was picking up where we left off.
Nope, that's okay. I was just gonna give Heather the opportunity to say a few words if she wanted to, and then I was gonna open the floor for questions. So
No, I think we've covered everything, so we can jump right into other questions you may have.
So think the thing that started this whole meeting and got you guys here was that we were having trouble understanding our budget with some of the things like the depreciation in there, because a lot of us are familiar with budgets, or maybe not budgets, but like profit and loss or balance sheets with businesses. And since this is run like a business, it's been a little hard to comprehend how we figure out. It feels like we're not talking about like what we have for actual money. It's like the auditor's version of the money, which is fine, but it's kind of like, we were struggling with that. So that's, and Bard, you can
And
be
what
eloquent.
often we expect to see or hope to see is year-to-date planned and actual expenses and year-to-date planned and actual revenue. So essentially, how is the business doing on revenue and expenses to this point in time? Versus waiting for a year and a few months to say, oh, I wonder how we did last year.
Yeah, and I think, and I can let probably Heather pick it up a bit, but as Connie and I spent a lot of time with Heather and Sam over the last couple of weeks, like it looks like the budget to actual report, or the budget status report every quarter gives a pretty good reflection of that. You look at actual revenue billed versus the budget, you look at actual expenses versus the budget. Connie every quarter has been moving over payroll from water to allocated to wastewater. So we look at those things so that we're seeing those in more real time. There are still a few anomalies in that. So like if a loan isn't due until May, you're not going to see that payment until then. So as we talked it through, and then I keep going back to when I first started on the Bolton Select Board, I always wanted to go to that bottom line because that's how we did it at the ski resort, right? Okay, we're halfway through the year. Are we making money? And you go to that bottom line and you can usually get a good idea. But I think it really sort of dawned on me as we're talking to Heather and Samantha more. In the municipal side, we want that bottom line to be zero. We want to raise as much as we're spending, basically. So I think, and it's hard to look at that because of the timing of things. So really sort of going by line and saying, okay, we're at quarter two, everything should be about 50%. If it's not, oh, that's a loan. It's not, oh, we had that big expense. We have $10,000 more, so it's still higher. So I think it has to be a little more tedious in this type of report to look through. You can't just look at the big numbers at the bottom because there are some things in there. And then when we get to the year-end report, quarter four, and this is where I'll let like Heather take over more, but that's when all those adjustments that Samantha was talking about at the beginning of the meeting get made. And it's not a NEMRIC thing. It's just the way the accounting happens. So that's where Connie, if she's able to then say, okay, here's the budget status, let me add back in the loans, let me take the depreciation out, let me add these assets back in, then that gives you a much better look at how much revenue do we have, how much actual expenses do we have in quarter four before we get to the audit. And Heather, you said it really well when we were in our meeting, so I'll turn it back to you as far as like how you use each of these tools as the managers on the commission.
Well, that and why.
Certainly. You are not the only enterprise fund that, I'm very familiar with, and it is not unusual for throughout the year to operate on a cash basis and do your budget on a cash basis. Because think about it, if you do not raise funds for capital assets or debt service, you will not have the user fees available to make those liabilities or pay those debts or buy those assets. So that's why the enterprise funds have one more statement than general fund does, and that's that statement of cash flows. And it talks about throughout the year how you budget and what for those outflows of cash, including expenditures, payroll, as well as your capital purchases and your debt service. So like I said, it's not unusual to have that be part of your operating budget because you need to reflect that and make sure your user fees are covering those assets and those liability purchase and pay off respectively. At year end, you take it from that cash basis and you put it into that full accrual basis because we follow not only generally accepted accounting principles, but also the Governmental Accounting Standards Board. And this fund operates, like Sam mentioned at the beginning of the presentation, like a business type fund. It's meant to be self-sustainable with your user fees, and that allows you to use those assets over time and then depreciate them. But depreciation is a non-cash asset or a non-cash expense. So those are some of the differences that you are going to see from the budget reports that you may see on a quarterly basis, especially at year end, as you compare it to the actual year end audit report, because you are taking it from the cash basis to that full accrual basis. And it is perfectly fine for you to, from a fiduciary responsibility, you're looking at what you raised for user fees is actually going to pay for in cash those expenses that you've budgeted for. That's what those budget to actual reports on a quarterly basis help you. And then we convert that information to the full accrual basis that allows you to satisfy your annual audit report.
Does anyone have a question yet?
I'd only observed, this is Bart, that we're steered then towards the quarterly budget status.
Mhm.
That's really the tool we have to say, where are we on course or not?
Every quarter, yeah, and I got a question, could you run a quarter four report on like July 1 before the adjusting entries are made?
It wouldn't, I thought of that, and it doesn't help because we continue to pay expenses for the last fiscal year, right into October of the next fiscal year. So yes, if I did it before I did the adjustments, you would still see the loan expenses there, but you wouldn't see everything we paid for between July 1st and the end of October.
Okay.
So that's why it's just easier for me to plug them back in.
Yep. I do have a question because I'd like a little clarification about depreciation. My family has an ag business, and when we do our taxes, we depreciate equipment, whatever, to offset, I guess, our tax liability. To be honest, I'm not really sure. My tax lady does it, and I give her the things. And some years are on like some things are on a multi-year depreciation. If we had a year that we didn't have 2 floods, then we might depreciate something fully in a year. So I'm confused a little about what depreciation means in this context because it feels different and I just don't know. Does that seem reasonable?
Okay, so I can take a stab at that and then Samantha can jump in. It starts out with, first of all, your capitalization threshold. And we mentioned that's at $5,000. There's 2 snapshots when you're looking at what is a capital asset. One is the amount, and we talked about that being over $5,000. The other is what its useful life is. So you could have something that lasts, like my cheap little solar calculator here, it may hang in there for 3 years, but I think it cost me like $1.55 at, Dollar General somewhere. So, it doesn't make sense to capitalize that. So it has to meet both prongs. Once you've determined that it meets both prongs, you determine what its useful life is. So, obviously your sewer lines, your distribution lines, all of that is going to have a longer useful life than, let's say, a laptop. So, you will pick what an appropriate useful life is. There are industry guidance out there that may, dictate or help you pick those. And then that's how long you're going to expense that item, because in theory, you're going to use it up over that time period. If for some reason the asset doesn't last that long, and you mentioned in case of a flood, if something happened to that asset before it was fully depreciated, that's when you would have a loss. So the IRS, and I know enough about this to make me dangerous and not do anybody's taxes. So, I will put that caveat out there right now, is So if you do have a loss, that would be fully recognized by the IRS. The other piece is, and I believe it's is it the 319 or the 318 assets for tax purposes, that for a while there, you could take up to, I believe it's $20,000 of assets that you normally would have depreciated. Like, let's say you bought a used pickup truck. Normally you would have depreciated that, but the IRS lets you book that all in 1 year. And I believe it's like the 319, 318. It's a three something regulation within the IRS code that allows you. So what's worse is you can have a different depreciation schedule for the IRS than you would for your accounting. And be glad you don't have to worry about that here, because you have to reconcile those two methods.
Connie?
So you hit on exactly where I was going to go. The town just sold one of their rescue truck, which was fully depreciated,
Yep.
to the water and sewer department for 20,000. So would that have a 1 year depreciation on it? the water
If
department.
they sold it, if it was fully depreciated to you or for you to you, and or I'm sorry, to them, and sold it to you, technically on their books they would have a gain on fixed assets on their entity wide, because during on their normal governmental funds they would not record fixed assets. And then you, as the purchaser of the new asset, even though it's not brand spanking new, let's say you deemed that it had maybe 5 more years left in it, you could capitalize it and over that, the $20,000 over that period of time.
Because you're just depreciating the amount that you purchased it for. So
Exactly.
it sounds like the depreciation for this is the same as what we do like at the farm.
Yeah,
But
exactly.
so is the depreciation schedule something that like, do you do it? Do you guys do it? Like who?
So
You know, like, we have
Connie
a list,
Connie
like,
maintains you got your fixed assets. We do offer services to where we would maintain that database, but Connie does maintain your database for that.
Okay. And then my other question about the depreciation is, we only ever use it for taxes, and you mentioned that you're using it for accounting. So sort of, what purpose does it serve in accounting?
The way that
That makes sense?
Yeah, I fully understand that. The easy way for us to kind of get out of the answering your question is, the rules tell us to do that. But,
Yes,
I'd like
which is fine, but I just don't
to
understand like why
offer
it's in there.
a
So,
little,
yeah.
a little bit more is, it would be hard from a ratepayer standpoint. And that's how I look at it. If you needed to buy, a sewer vac, and those things are running, $450,000 right now. From a ratepayer standpoint, from a cash, you're going to have to either raise it or finance it. That's through user fees. But you're still going to use it up over the useful life, so you're not hitting that big expense all in 1 year. You're kind of normalizing it as you're using that asset. So if that has a useful life of 20 years, you're spreading it out over 20 years to normalize the expense on that particular item.
Okay.
And just to kind of piggyback off of what Heather said, so typically when we look at enterprise funds that have capital assets on their books, that expense, so say you went and bought a piece of equipment for $20,000 and that cash leaves your bank account, but that expense doesn't hit your budget to actual, because it is then, if it does, we then remove it out of your expenses and add it to your capital assets. So that expense isn't hitting in that year that you purchase the piece of equipment. You're expensing it over the course of its useful life. So you're expensing it in increments. So that, like Heather said, that expense isn't hitting all in 1 year.
Okay, that was what just bling made it go.
Yep.
Okay,
Yep.
all right.
That was one of the lines on the budget status report that I made the little note
Yeah,
that they pulled out
Right.
the cost that
Right.
we had asset as an expense. I
Right.
put it back in for us trying to do revenues and
yes.
expenses.
okay.
Can you give the explanation of the VEMR's adjustment? I tried to explain it to the commission in the memo, but I think it might be helpful to have that explanation in the meeting for anybody else who might be curious.
Sam, do you want to take that or do you want me to?
You can take it. I just really learned about it last week too, so just
Yeah, Heather, you did a great job with that last week, and it made me understand it better.
We
so.
really should have tape recorded that.
we should have tape recorded that meeting.
I'm like, okay, what did I say again? The easiest way to explain it is it recognizes the current employees' contributions plus those contributions for employees that have already retired. So it looks at the whole group of employees, and then you have an actuarial evaluation that says, okay, this is how much we think your liability is going to be. Recognizing, and nobody ever, I shouldn't say nobody, most entities never fund that full liability, because it's impractical to do that from, a revenue tax-based standpoint. Plus, there's always so much fluctuation from year to year. So, for instance, your unfunded liability, which is just what it sounds like, it's the portion that hasn't been funded yet, may be $200,000 this year, and it may jump to 250,000 next year with everything else being constant, just the way the stock market, the bonds, the interest rates, and that rate of return will change. So that's why you see from year to year some of those adjustments to that unfunded liability, because the rate of return will change from year to year. Your actuarial may change. Unfortunately, people get older, some die off, you may hire younger people. So that changes those actuarial calculations. Those changes in salary adjustments will impact that. So you have a number of things that impact that total unfunded liability from year to year, and that reflects some of those changes. Unfortunately, this is one, well, I'll have to take one for the team, where GASB has made this terribly, terribly complicated, more so than it probably needs to be made. And, they take it one step further, and they actually have to strip out or itemize, if you will, how those changes are impacting your unfunded liability. You will see in your footnotes, or in the footnotes of the town, that section makes up almost 25 pages of your footnotes, because of the requirements that, you have to talk about what investments they're doing. What's the rate of return on those investments? What's the maturity value of those? So it really has made it very cumbersome, and we can thank the big cities like Detroit and Philadelphia, all of those that did not fund their pensions adequately, that everybody, including small, municipalities out there, have to now incur these costs to do that.
So for when we're looking at the budget, it's kind of an imaginary number when we're planning what we have for expenses. It's like a worst case scenario number.
Well, from a budget standpoint, you are actually budgeting for your required contribution. What you are not.
Because when I read what was in the packet, it made it sound like that was like, if it totally went away, we would owe that line.
So Heather, sort of the way that I guess I understood it and explained it. So like what we budget for is a certain percentage of the salaries that we have to contribute as a town. So it's like 5% of every dollar we pay goes to VEMR's, and that's hard actual money that we pay every 2 weeks weekly salary.
Yeah.
And then, so Heather, as you were explaining that similarly last week, I asked a question that, like, basically the only way the town would ever have to pay that adjusted amount would be if like VEMR's as an entity ceased to exist. And then we had to fund that to pay people that were already on that program. That's where it would then we have to pay that. But since VEMR's is likely to continue and remain funded, we should never really have to pay that money, right? Because and when you talk with the actuary, that's VEMR's bringing it in and saying, okay, we employ this number of employees or cover this number of employees across the whole state. Here's the total amount of money that we owe them. Here's the total amount of money that we have in our fund. Here's the expected return on that. If we went out of business tomorrow and got no more contributions, here's how much each entity would have to contribute to pay for their employees to make sure that they get covered as they were promised till the end of their time.
Right, that's why I was asking.
Right,
It was
and
kind of
that, 'cause
imaginary.
that's sort of the basic idea that it's imaginary, but like if for some reason VEMR's blew up tomorrow, we would owe that $50,000.
Imaginary
Right.
might not be the right word, worst case.
Yeah, it's technically what it's known as a defined benefit. You get a benefit versus a defined contribution, which is more like a 401k, where we've defined what your contribution is, a 401k. Conversely, we've defined what your benefit's going to be. It could be, they all vary, 50% up of your top 3 salaries. I will share that, another way to look at it, which is just opposite of what he talked about, and it is it's an ability in Maine to do it. Maine has the Maine state retirement system, and you can actually, with the exception of public safety and teachers, municipalities can actually elect out of Maine state retirement. They can make that election. When they do that, they actually have to come up with how they're going to pay that remainder of the balance. And because they have to make Maine State whole for that unfunded liability. So that's kind of another way to think about that, and it aligns with what the explanation that was provided.
We can't do that in Vermont. Once the
Yes,
veterans vote,
yes.
it's always there.
Mhm. So going back to my question, so that line,
The budget expense line is the actual percentage of gross wages that the town pays during
We're
each payroll.
okay,
The only time the other number ever shows up is
is
at
in the very
year-end
end one,
adjustments.
right? But but in that year-end adjustment, that's a worst case scenario number. That's not what we're physically doing.
We will virtually never have to pay that.
So why do we include that? Just out of curiosity?
That's-
Like, I'm not trying to be mean, I'm just.
Well, when she says
Yeah.
GASB and generally accepted accounting principles, it's the standard accounting regulations used in
Okay.
governmental accounting across the US, and we simply have to.
Okay,
Remember when your mom and dad told you to do something and you asked why, and they
Yes.
said, because I told you? In this case,
I still do
GASB
it
is the
40
mom
years
and
old.
dad.
Now I'm doing it to you. I'm just trying to, I'm just trying to understand, because I'm not
No,
familiar.
that's perfectly, pensions and
Mhm.
specifically are a tough thing to kind of get your arms around.
If you recall, we've been beating up as a nation on the post office for literally decades.
Yeah.
Because of the law that requires the USPS to fully fund its retirement obligations for employees that have not even been born yet.
Hmm.
And that's why they're financed. If you set that rule aside, they would break even. But because Congress, for some strange reason, years ago, made that requirement, they can never break even because they're always, how are you going to make enough money to pay for future pension
Employees, yeah,
obligations? You can't do that. So it's not very smart, but that's one of the ways that they,
are missing.
you
Does anyone have any other questions, or is it time to move to the next item?
Good.
No? Okay, all right.
Thank you. It's been a pleasure meeting with you tonight.
Thank you.
Thank you very much.
Thank you both, appreciate it.
You're welcome.
Do you feel like I understand some of those things more?
No, and I do too.
And I appreciate that you guys let us ask all these questions and.
No, I think it was a good process because like we've never really dove into it that deep on water, sewer, or on general fund. So Yeah, I mean, we probably had 2 hour and a half long meetings with both of them. But I feel like I understand it a lot better, and also I kind of understand how to look at the budget status reports every quarter a lot better as well.
Mhm.
'Cause with their insight of like, oh, here's what you need to look at, here's what works. I thought it was helpful, so I'm glad that you've also found it helpful and enjoyed the evening this evening.
Is enjoy the word we use?
Yeah,
Okay.
this is fun, as Jay always says.
Okay.
The biggest benefit of being on the select board is you get to serve on the Water and Sewer Commission.
It is.
That's right.
It is.
Well, the best part is getting to sign things at the end of the
Well,
meeting.
there's always that too.
Yeah.
All right, so you want to jump into budget?
I do,
Okay.
because you said we're having fun, so.
We're having a lot of fun. Okay, I'll share my screen here. We'll start with water, and it's a little too bad that Steve can't join us, but this is our first pass of probably 4 or 5 before we get to the annual meeting.
We are trying a new look,
You want to talk about the new look? That was gonna be my
New
first
look.
thing, but you can take it away.
breaking it into categories. Steve and I are very excited about this.
Excellent.
I think one of the things that he struggled with is being new to our chart of accounts, which we know is a mess.
Which page are you on? I can't see that.
Oh,
You're on the
this is-
first
this
page?
is the water.
It's all water.
Thank you.
So revenue at the top, expenses at the
couldn't-
bottom.
Yeah, I just couldn't see which tab you
Oh,
had at the bottom.
Yeah.
So I looked at the audit a little bit to kind of give me some guidance as to how we wanted to split this up. It doesn't follow it exactly, but that may help us more next year when the next audit comes out.
Yeah, so for instance, sort of looking at it, 30,000 foot view, we still have revenue altogether. And then we go into a subcategory for expenses of payroll. Staff related expenses like uniforms, training, association dues. Administrative expenses, computers, office equipment. Then we have supplies, and then we have utilities, so telephone, heat, electricity. Contracted external services, so the audit, water testing. Equipment rental, equipment tool purchase, and then we get into repairs and maintenance. And that gives us our total operating expenses, but broken into some categories. So we can see, well, okay, what did staff related expenses versus equipment cost us? And then water debt is still in one chunk here at the bottom for all of our loans. And then wastewater structure, I think, almost identically.
This spreadsheet feels very comfortable to me. This is how we do it at the farm. I
Okay,
don't have any questions about how you divided all this stuff up.
awesome.
We were debating as to whether we wanted the totals after each category, and I thought maybe to start with, that would be good, and if we feel it's too much, we can remove the subtotals.
I don't think it's a bad thing. Just because then you can kind of instantly compare it year to year, especially with things like payroll that like changes
Mhm.
depending on how many people, and I like it. Bart?
So,
And if we go down to the bottom, all the way down there, I was intrigued, why are debt and reserves combined in the total debt and reserve?
Because they're not operational expenses. Everything above it is operational.
Right, but should they just be their own separate lines and not combine them in one subline? Is that what you're asking?
Yeah,
I hear you're kind of different. They're very.
one is money you got, the other is money you owe, and I
Yeah.
don't think they should be,
Mhm.
it seems odd to
So
add them
if we
together.
just, if we just deleted this line and then redid our formulas here, right? You would then have three major subcategories, Connie, does that make sense? You have operating, total debt, total reserves, and then you have your total expenses down here.
I think that makes sense. I just, because again, I think of debt is I owe something, reserve is
Mhm.
something
Yeah.
I've got.
We
and-
had them together on the old format,
But
but I
New
view them as
formats
very
bring up. new
different
ideas.
things, which
Yeah.
is why we were just having some of the conversations we did.
Fair enough.
One thing that I noticed is I think we may want to up our uniform budget in 26.
Yes.
To pay for those
Seeing
new
that we're,
logos.
yeah, because I would imagine, and I don't think they've bought too many uniforms in the past couple of years. I don't know, but
So yeah, if they're, well, I thought that he said they were gonna buy as items needed to be replaced.
Yeah,
yeah, but still, I feel like this is not judging, but like they all need hats, they all need some jackets. Like it does seem like they are due for some,
Well, I have no objection to raising it if we have the
yeah,
revenue to pay for it.
All right, I'll make some notes.
good point.
It's pretty minor expense, but
Comparatively,
yes.
Yeah,
If things would stop blowing up at the plant and needing to be replaced, we'd be golden.
And then I like again, at the bottom, the total revenue, total expenses is helpful. Give you a chance to do
Yeah,
that.
that's right. At the bottom.
is it really true? Oh, yeah, never mind. Never mind.
Okay.
Having a blonde moment. The budgeted versus,
Or other percentage differences.
like at the bottom where it says like the numbers are exactly the same for revenue and expenses, because it's the budget.
In
I
the
was-
budget, they would be, yeah.
Yeah,
although
just having a moment.
No, where I thought you were going was if you look at, where's our actual, it's in wastewater. There's 1 year when it was actually the same. So here's actual, right? We, in FY 23, we had 902.
Oh, yeah.
But that's because we also budgeted a fund balance use. So we budgeted more than $16,000 in fund balance use, only needed 16,000, and that's when it came out identical.
Okay.
Only because we used less of fund balance than we needed to. But yeah, that's where I looked at with kind of went, wait, what? And then, that's where it was.
I'm like,
But yeah.
how did we
But
manage
yeah,
that?
usually every other year, you've got $37,000 difference, $41,000 difference. The other thing about this that we hopefully will have at our next pass of this, not next week, but in April, is rates. So we build the rate chart based on actual usage from April 1st through the next March 31st. So when we have 1 full year of actual usage, when we build the rates, we need to get to the end of this March, the end of this month to have that full year look back, and then I can plug that into our rate sheet. And then we'll start to be able to know rates, because right now, we don't really know what a difference in receipts is gonna be for water or sewer until we plug it into that rate sheet.
So the third year that we work off of for numbers,
Yeah, right, yeah, we have that, yeah.
the actual year, the fiscal year, and
Yeah,
the
that is
rate
true.
year. Okay.
But yeah, it sort of seems to have been the most consistent because it's the most
It makes
recent
sense.
last 12
Yeah.
months of data. But we'll get that in there shortly. And yeah, now that we're through COVID, we don't have to deal with those adjustments because that was challenging. When the school was shut down for basically 6 months, we had to and nobody was going to businesses. It was a little tricky.
Yeah, Bard?
And this is really just semantics, the fund balance usage, that refers to using reserve funds, right?
Fund balance usage, I think, is our restricted funds. So maybe we say restricted fund balance usage
Something like
to make
that, yeah.
sure.
Like the
Yeah.
reason
No,
fund
that
set
was
aside for water and
unassigned.
sewer replacement.
Oh, sorry, unrestricted. You're right, unrestricted.
Unrestricted.
So it was not reserve funds, it was unrestricted.
I was just looking to match
Yep.
up to what we talked about earlier.
love it.
Restricted or unrestricted.
Yep.
Just to be clear.
So the
Let's do that.
restricted at the bottom, so say we budget 10,000 and we use none of it. Then I go out to our fund balances on the trial balance. And okay, well, we used none of the 10,000, which means that went to unassigned funds. And I adjust it and make the unassigned funds give the fund the money that didn't use it at all. And same in reverse, which is what we saw with the wastewater capital fund. We spent more than we had budgeted for.
And so you're saying that the wastewater capital reserve. Right, okay, that's the restricted. fund.
And I'm gonna make a note of that because I think I like,
So if you look at
Making
the
sure.
trial balance.
No, I was making sure I was,
Balance,
Yeah.
and 3 sub fund balances, which is not typically done. Remember years ago, they told us you can't have reserves in the water and sewer department. And
yeah,
I'm like, well,
you want
I'm
that.
creating sub funds then.
I just wanted to make sure I was reading the restricted
Yeah.
in the right place.
No, I think making it match the audit as much as we can would be
Mhm.
super helpful. So we'll make those changes. So really, we sort of back into our user receipts after we do everything for expenses. We kind of figure out what are we gonna estimate for sale of water, what are we estimate for hook-on fees, fire service fees is a calculation that comes through as far as 5% of the water budget, and if it's 48% of one of the water tank loans. net interest on checking. So then this number is essentially, what do we need to make it so that it's zero at the bottom, expenses minus revenue? So salaries is based on all of our current staff plus a vacant position. We've added in things for increases in certification attainment. We think Brad's gonna have a wastewater 5 here shortly, we hope. And with that comes some salary increase, also the increase on January or July 1st for a step increase in the grid adjusting. So we've added that into the salaries at this point. Yeah.
Question about salaries. When we approved the fourth person, it was when we were starting the meter installations. And that was going to be helpful for the meter installations. But now we're almost done with that, and we don't seem to have a fourth person or anyone
We have some
necessarily into
Yeah,
this.
so we did have a fourth person for the fall.
Right, but now that person left,
Now that
like,
person
do we
left.
consider going back to the 3?
I think he still needs more people. think
I
he's
agree
right.
based on his work.
4 people
Okay.
total, including Steve.
Okay,
So yeah, meter installations alone, there's always the next project that I'm sure they'll jump on. I know we've had a couple applications. I think he had a couple people, but it hasn't been real hot with a lot of applications.
Okay.
But I'll follow up with Steve to see if he's got anybody in the hopper at this point.
okay. I wasn't trying to like take them away. I just
Good
wasn't
question,
sure
yeah,
if like,
Fair question. If
we
don't
get
have-
that done,
if we
like, is
don't
it
have to
not
look at
needed?
the Project, you still need the person, but I think that we always.
But we were also looking to, get apprentices and train them up. And is there a state program that we go to for the apprentices or?
There's a state program that we go to for the training, that's the Rural Water Association, so once we have somebody, they go to that program. They don't really have a program where they're training and then turning them over to us, it's more, you hire
What do
them.
we call ethics and look to see the ethics technical?
Yeah, I think we've done some of that to try to like reach out to some of those places.
I just didn't know where we're reaching out.
Yeah, I'll have to double check and see if Steve has done any more of that. I know we've tried to advertise in certain spots like that to get some younger folks, but yeah, we can try to make a more concerted effort.
Barb?
Just, we'll go back and forth here between water
Yeah.
and wastewater, and just for the record, remind us of how we break out payroll and staff expenses between water and wastewater.
So that's a 70-30 split between 70% is wastewater and 30% is water. That percentage was sort of developed before my time, but I think the idea was like, where is staff time mostly spent? And a lot of it is on wastewater with all the operations that they have in wastewater. Whereas water, with the exception of installing water meters and the leak they're dealing with right now, a lot of time water is a little bit more set it and forget it. You sort of check your pump, you check your fluoride levels. It's a lot less labor intensive.
We were talking last week about, when was that study done? How did they come about that study? But when you look back at it, even if we had it done again, I wouldn't change it because there's many, many years where everything's going to water. But right now we're doing, everything is going to wastewater. So it's like, if you were gonna do another study, you're gonna have to do it every year to see what the status of our system is because it'll constantly be changing.
It strikes me, it's also somewhat arbitrary because with a few exceptions like sale of water, where it's only water, or septage that's only septage, most customers, with some exceptions, are both water and wastewater. So for the average customer, it sort of doesn't matter how you break it out, but it really does matter for a customer. If you are only septage or only water, you'd want it to be accurate and that your rates then are reflecting the cost of work associated with your part of the system.
How many other people are there that are only one?
Jericho, Sandwich Farm,
Yeah.
I
It's like
think,
3.
has one
Yeah.
water line. And there's something else with water only.
Okay,
I thought at one point there were 3.
I think the Round Church
Yeah.
might have water only.
Yeah, because they have. a
that would be
porta-
logical.
And
Oh, the
Yeah.
Catholic Church.
the Catholic Church too?
There was an anomaly. I'm not even sure what the resolution, I don't remember what it was. They have a water line up at the cemetery.
And the dead people not using the toilet.
But
So,
we do water them.
so there's water there. I'm not sure how that's calculated. At one point, there was no charge.
I don't even know, are they on our list? I don't even know if we do build the cemetery? Do they like part of the lawn or something?
They use it for people to water flowers. and
Okay.
I
dirt.
actually, yeah, I know
need
what
water
is before
sometimes.
then.
Yeah.
When you're burying people, I
Yeah.
would guess.
Maybe you do.
Yeah.
I'm not that familiar with undertaking business, but I guess you might.
You live on
Very
Cemetery Road.
You'd think. I know.
You know there is a cemetery on that
I've
road,
been
right?
there.
Okay.
And I just started reading the
Yeah.
history of Richmond, so I'm getting more up to speed. 6 years into my job, I'm learning all about the different people that have lived here over the years.
Okay.
Oh, Jeff Ford says in French Forest Forum, he's not going to be the town energy
I did
coordinator.
see that. Yeah, I don't know.
This is your chance for one of your kids actually
To,
to be
what?
town energy coordinator.
They could do it. They have a lot of energy.
If they can pass the ag test, they could probably.
yeah, exactly. Be the energy. I don't think our usage is probably pretty small with just the water, so I'm happy to have it go to both if it needs to.
Well, yours would be higher than the cemetery, I think.
Yeah, I think so, because we're
Oh.
living.
But it only is to illustrate the point where we want to be at least roughly accurate.
Mhm.
But the only alternative is, I think you suggest, Connie, a time study, and you typically do like a 2-week schedule. But it assumes that that 2 weeks is representative of the 52 weeks, which it often is not.
Mhm.
So it's kind of an estimate anyway. Unless you positively reported your time for the entire year.
It's true. The house savings account,
Mhm.
it has a negative percentage and we're bringing it down. Is that because we're not using it or they make the contributions?
This is the health savings account in lieu
Yeah,
of
we
being
had
insured.
a staff change on it, and there's only one person over there that does the high deductible.
Plan?
Insurance.
Okay, so that's why.
Yeah, and the way, that's right.
And then what we do with that is the town pays 90% of a regular plan.
Yep.
But of a high deductible, the town pays 100%. And the difference between the 90 and the 100% is what the town contributes to an
To
HSA.
Health savings, okay.
So like a single person policy is like $30 a month.
Okay.
What policy is Ducon?
Excuse me?
What policy is Ducon?
The police dog.
The police dog.
Do we offer,
Let's see, he's on the overtime policy.
but you know, there is pet health insurance, Trupanion.
It's true.
Oh,
Yeah.
And
I
they just
keep
pay
him-
for a big bill for my
He
cat.
has treats in my desk.
Oh,
That's his
good.
policy.
The,
And they're
um,
healthy
And
treats.
his vet bills would be covered by the town too. Yes.
Is there a line for that?
Well, that's not in the
This
water.
is why-
Thank God, no. We're glad that's on someone else's. So some people must not take insurance.
Right now, everybody takes. it.
All 3 of them do? Okay.
But yeah, the town's liability or the town, we pay everybody who's the same.
Okay.
right?
Yeah.
That's why the HSA comes in. I should
Yep.
explain.
Okay.
So we have 2 people on 2 persons and 1 on a single.
Okay. I just was trying to figure out why it had gone down so much in
Just
3
changing
years.
policy.
Yeah.
Well, when we're budgeting too, we budget the vacant
Yeah.
position for a 2-person policy on both health insurance and dental.
Oh, that's good to know.
And we
Okay.
do it on the platinum so that you wouldn't see an HSA. So if that person showed up and they wanted the HSA.
It would change.
HSA would go up,
Mhm.
but the premiums would go down.
Okay.
So
Pardon?
this past year, we did have where we budgeted for a 2-person vacancy, we hired the position, they did an opt-out.
Okay. Yeah.
So this illustrates a conversation that happens in the town budget as well. How come you're budgeting for every position to be filled for the year? And it has always been my conclusion that that's the responsible thing to do, to
Yeah.
assume that you're budgeting for 12 months. And that you're budgeting for health insurance, and in some ways you over budget. And then you may have excess revenues to deal with. And in the town budget, we've many years used that to offset taxes for the subsequent year. That's a whole other conversation for the water sewer system, especially as we're looking at a, what, $20 or $30 million expense in the upgrade.
That's actually a good segue to this chart,
Mm-hmm.
which shows, let me see, oh, it needs to be a little bigger. Let me get that bigger for people here.
Oh, God.
Please don't launch missiles at Moscow. Just
What?
don't.
Okay. I made it
So,
bigger on my computer now.
it's a little bit
do
too
that.
big now, sorry. Anyway, I'll probably go with this. So on this chart, I tried to take a look at the restricted and unrestricted funds. So this is the chart for just water. So unrestricted was a year-end balance of $156,000. That's essentially our starting amount of unrestricted funds for FY 25. We know we're going to get, we had $38,000 coming back to us from the waterline inventory. So that's unbudgeted revenue that's coming in. We have to pay about $15,000 for the water monitoring service that Steve is working on finalizing here shortly. We had about $1,600 in flood expenses. So when you take into account what we know is coming in, what we know is going out, we're looking at $177,000 year end. To back to Bard's point, any vacancy savings that we have in there will be reflected in that actual audited number. So that money doesn't just go away. We track it, we can use it. Then the water budget in FY 26 right now is at $387,000. So 15% of that is $58,000. And we use 15% because the auditors in the years past have told us it's good to keep about 15% of unrestricted funds on hand in case there's an emergency of some sort. So that leaves us
For cash flow.
for cash flow or but
Because we're not really
yes.
supposed to have emergency.
No, you're right. It's both. It's more cash flow.
And that's the percentage that sometimes the audience has argued with us shouldn't be more than like 2 or 3%, right?
And some people wanted it to be more.
Okay.
So what the select board did and the commission could do too is the select board in the fall of 23 actually adopted a policy
15%.
15%. So we could bring the same policy to the board to this commission if you wanted to consider it. So that way you can, anybody from the audience says it should be 10. Well, we already said it should
Josh,
be
I move
15.
that we set the policy to be 15%.
Okay. I'll bring we can draft a policy for a future meeting. But then what that leaves us with projected is $119,000. So as we look at rates, we might say, hey, let's use $50,000 to reduce rates. Or we might say, Steve might say, well, guys, I got this big project coming up. Let's put some money towards that project. So I expect this sheet here to change probably a lot in the next month.
Bart?
So it strikes me that there could be a down and an up. So if we said we want to hold it 15%, so you, as the select board did, we might decide to use it to offset the next year's rate. But then when we say, what are the other projects we have coming up and are we going to pay for them or not? Then you'd probably want to add them in if you know that those expenses are coming up, other than the big ones that you're going to have to bond for, like the treatment plant. And then you put them into the budget, like assume it's not just staff time, but if it's another kind of expense, a contractor or a purchase, that would be an up. So you could have a down and an up that still hits 15%, and you may or may not end up reducing or increasing rates based on the up and the down and how they compare to each other. Does that make sense?
I think so.
So it seemed to me the question of, are there other projects coming up that require things? The other thing I'd say is to keep an eye on our reserves, because we've run into a bunch of circumstances in the last 2 years where, unexpectedly, we need to do this, and it's $100,000. So the different reserves and the unassigned funds, I just feel like we're in a place now, at least in wastewater, where maybe we can sit back and say, what do we really expect between now and the plant upgrade? But part of it's predicting the unpredictable, right? Like, when is something going to fail? When is a pump going to fail?
And I feel like we have a really old used car right now. And until we trade that in, the 15 seems like the safe thing to do because we're at the tail end. And I mean, everything has broken, so maybe it's all been replaced, but it feels like it feels like it would be good to have that, once we have a new upgraded plant, that's like having a lease on a car.
Yeah.
Or a car payment, like maybe at that point we reduce it again.
And I'll point out that this table shows both the unrestricted and restricted. So, I think as a commission, we probably want to look at both. 15% makes sense for unrestricted. we also should keep an eye out for the restricted and what expenses do we expect to come out and what do we want to put in? That makes sense, the ups and the downs within the
Mhm.
reserve.
Yeah,
Because the restricted is kind of like a savings account that we have to vote on,
So
right?
the restricted is broken up into these three different funds, wastewater capital, short-term capital, collection system. So the commission makes a decision about how much money to put into each one of those. And as Connie said, there are times during the year where we'll say, oh, that should come out of wastewater capital.
Mhm.
So we'll just use that line, and then less basically goes back into reimbursing that. And to Bard's point, yeah, I think it was 2 years ago in the budget, we left a lot of money in unrestricted or in, unrestricted because we knew, like, because that was when like every week Steve was coming in going, this broke, that broke,
Right.
and we said, we better save everything we can. Whereas last year's budget process, Steve actually had a list of things, like we had the influent pump in there, we had the press repair, we had the grit removal, we had the water monitoring system. So we had a spreadsheet last year where we calculated, all right, which of those are coming out of unrestricted, which are coming out of water capital, and then what, if anything, can we put back to the budget? I don't think we put anything back to the budget last year because we were still in that same, like, let's catch up mode. And right now, I think we're stabilizing a bit, but it's always good to have some reserves in case something breaks.
I think I'm thinking of the, like, if it's over a certain dollar amount, we have to say it's okay to use it. Right? Like you can just write a check if it's under a certain amount, but if it's
Oh.
over a certain amount, I think that's
If there's
where I'm
like a
getting,
repair or something, the commission has
confused.
to approve it.
yeah.
Yeah, so I guess there's a couple things there. So anything under $10,000 that's in the budget, the town manager can sign off on. Anything over $10,000, the commission has to sign that purchase order, even if it's in the regular budget. So if Steve's buying $20,000 in chemicals, it's in the budget, you guys gotta sign that PO.
Okay.
If it's $8,000, I can sign it. If we want to spend something out of the capital reserves, even if that's like $100, we would come to the commission because only the commission has authority to spend out of those capital reserves.
Okay.
And that's where then you guys would make that approval, yes or no, we'd spend out of that.
Yes, Bart.
So Josh, you just alluded to, a list that Steve had of upcoming purchases, repairs, et cetera. Is that something that we could anticipate as a yearly sort of what's coming up?
Yeah,
Yearly product that would then impact this budget discussion?
I think so. What I'll do is we'll for the next meeting, review the list with Steve and sort of see what he thinks on the horizon. I think the biggest thing is going to be that 20-year study, but he might say, oh yeah, there's 3 things over here that we got to attend to. And I think that's another level we got to dive into. I don't think he shared anything. You guys basically just went through line items, right? He didn't start talking about it. So we can get that for the next meeting.
Or even the first meeting in April, since the next meeting is in 6 days.
Yeah, and so on that, I think it doesn't make sense to go through the budget next meeting because I won't have rate numbers at that point either, unless there's
Right.
major questions you have here, which I'm not sensing right now. That would give us then a couple weeks to talk to Steve to finalize or to revise and refine the unrestricted and restricted usage. And then assuming we have data by March 31st, I just need a couple hours to update my spreadsheets. We can drop it and we'll have sample rates for you guys on the sample.
We also need to look at, budgeting for additional revenue because sale of shirts, caps, jackets, event rentals for people that hold weddings at the plant. There's potential new revenue streams.
Mhm.
You can get a logoed nose plug now. Makes weddings much more attractive.
Bart.
So I want to draw a parallel between the water sewer budget expenses and the town. So the town, when we do like minor repairs to the building, there are similar issues with the wastewater treatment plant, but when it comes to the replacing the plant or upgrade, it's like the town center building, the scale is so different, it's hopeless to try to save for it. So it seems to me we want to be saving for the modest things, the sort of operations and maintenance,
Mhm.
but those major things, like, I don't think it's prudent to try to save money for the wastewater treatment plant upgrade because it's so insignificant. Also, this is an issue that's come up before. If you save for everything in advance, you're taxing people or charging people today for something that they may never benefit from.
Mhm.
Like if we had higher rates for 10 years to pay for a plant upgrade, so I'm taxing somebody who's here today who may not be here or be a resident of the town at the time that it actually, the expense and benefits are incurred. Does that make sense?
Yeah, absolutely.
So I think I want to just be clear, we should be resigned to a big bond at some point. And I'm hopeful that there is some offset, as you suggested, like we go from an old used car to a brand new lease. Ideally, in the beginning, the repairs and
Maintenance and
replacements
things.
and purchases are going to be much lower. But we'll see. I want Steve's opinion on that. And that was also one of the things we did with some of the line replacements over the years. That if you replace the lines, you pay for that, but now you're not paying as much for leaks.
Mhm. Is the Tilden Ave and the Cochrane Road projects, are they gonna happen this summer?
Therein lies the question.
Yeah, that's, so just to give sort of the 30-second overview of that. So it's all going through a DWSRF loan, and that'll have to be approved by the state before we can go out to bid. It's been a very long review process where they didn't even get to it for a while, and they would get to it, and we would give them more, and there would be another delay. So right now, I think I have to double check with Tyler Billingsley where we're at, but I think we've answered most of their questions. I think there's still a few things they need from us. But we also have to secure some easements, quite a few actually.
For the curb stuff, yeah.
Which is gonna, I mean, just writing them is gonna take time, and then trying to get each individual to sign off. Either way, that's gonna take some more time. So at this point, I don't know if we're gonna hit this summer, just because it would be good to be out to bid yesterday for that for construction. And yeah, everybody's getting anxious about it because nobody likes the potholes on Bridge Street. Pete wants to repave. We're tired.
Well, that's what I was
leaks up
gonna
there.
ask.
Yeah. Well, Pete's like, look, I've had this. He's like, I've wanted to pave this 2 years ago.
Yeah.
He's like, but I keep waiting because he doesn't want to pave it.
When I started, he was talking about that.
Oh, yeah. So like Pete is being patient, as well as the residents who drive Bridge Street every day with, once we get the water line done, we'll pave Bridge Street and it'll be beautiful. But it's taken some time.
Speaking of which, as I was coming here today, and this is a state road, but the frost heaves on East Main Street are something to behold. There, you can see the ripples.
Yeah, same with the Fulton Valley Access Road, not our town, but I drove that yesterday. There's some potholes, it's tough.
Yeah.
But it's winter sometimes.
Mhm.
But you would think, right, they just redid that road.
Right, and it's supposed to be an
Yeah.
all technology.
Sorry.
But it's boom, 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 boom.
Yeah, you would think that just because they just rebuilt that road, they should have had Pete in charge of the project, it'd have been nailed.
I
We would have
assume,
wider shoulders too.
I assume it would be a pipe dream to section off that little bit of Bridge Street to get that and use some of our,
The one around the corner there,
because does the line need to be replaced like from where Cochrane Road starts to the bridge?
I
That's
think
so
it's from I think it's from the other side of the bridge all the way down to the intersection and then down Cochrane Road and maybe a little bit up Thompson. So I think it's a larger stretch than just the intersection there. And efficiency wise, to replace 100 yards.
Oh, no, I meant to do from Cochrane Road to the bridge.
Oh,
I just didn't
well,
know if that was something we could bite off without waiting for the,
and, it's hundreds
state.
of thousands of dollars, if not. I mean, I think the whole project is like it's over $1 million.
Okay.
I think maybe 2 million, if I remember correctly.
Okay.
We have the bond approval for it. Yeah, it's just the slower process for the state,
okay.
unfortunately. I mean, I was driving it this morning thinking about it too. I mean, I know when the weather breaks, he'll go out there and he'll patch it, but that only lasts so long.
Mm-hmm.
So, all right. So that's sort of, I think, unless you guys have more questions, that's kind of what we got right now for the budget. I think April 7th we'll come back hopefully with a look at some rates, have some more information from Steve. We'll make some verbiage changes based on the feedback tonight. We'll look at the uniform budget to see if Steve wants to add some more to that, and we'll keep the process going. And maybe at the next meeting, we'll talk about the goal date for annual meeting, which would probably be third Tuesday in May or something like that.
Okay,
One thing we can think about is where do we want those reserves to be at?
Yeah.
You know, maybe we don't.
Percentage or money
Not
wise?
percent, the restricted ones.
Okay.
Because what you can do is you can take, so say we know we have some big expenses and the rates are gonna go up, well, we don't want the rates to go up. Okay, so let's throw this much in unrestricted money at our restricted reserves. And then, I mean, it boils down to the same thing, but you just use that to offset, but you'd be putting money into those restricted reserves for those things that come up that are going to be big items that we won't be getting a loan for. And I don't know what that sweet number is or what plans we have for things that aren't related to a revolving loan through the state. So that's kind of why we got away from using our reserves, because we had all those revolving loans that became available to us.
And do we have like the farm has like a line of credit to buy like crop expenses? Because those are in the spring and then you don't get paid till October. So does the water and sewer department, we don't have any like line of credits that we can be like, oh, there's this big thing, can we pull from it or bump the number up?
We don't. At one point we did, and that's because we thought we were going to have back-to-back projects. You know, the Ridge Street first section, third section, and then Tilden, but all these loans kept coming available with 0% interest. We ended up not using it. Finally, after 3 years, we're like, okay, can we just close this? Because I'm getting tired of reconciling $10 every month.
I kind of remember maybe when we did
So
that.
it's easy to get if we need
If
it.
we needed to, okay.
Connie really likes dealing with small numbers, like when I was sending payments to the town's fund.
Oh, she like that.
Donate to that.
I just didn't know how it worked because like we don't always use it every year, but it's like super handy. If we need to, you just pick up the phone and say, I would like to tap in. So I just didn't know how that worked versus.
Yeah, we
having it
did
restricted,
now
unrestricted.
because the state was going through so much and taking so long to get our money back.
Yeah,
With this
Unlike their
revolving
years of
loans
speedy
that we
performance.
wanted that just in case we ran out of cash. We never did. The cash flow is really good in the water department.
okay. All right.
And
Fine.
the other thing we've talked about in the past is when interest rates were really low, you don't get much on savings or
Right.
certificates of deposit. And B, you didn't pay a huge amount on the interest rate on money you borrowed. And that goes up and down. And I'm lost where exactly it is now. It seems like the economy is perhaps uniquely uncertain at the moment.
Now,
Depends on the day, right?
there is one budget line on the sewer side, wastewater side, excuse me. I need to convert that in my brain. And that will go down to the debt, Josh. I think that's where it is. And if you look at the phosphorus line, we've always had it as just one line, which was always one line way before my time. So the auditors have always said, no, keep it as one line. There's actually an admin fee related to it, which is similar to interest. This year, the auditors decided to split it. So that's why you're seeing that little tiny change.
Thank you. One of those small numbers you love.
Mhm. Yep. What does the SRF stand for in that?
State revolving fund.
Okay, thank you. And the years are when they come due? Like when we pay them off, 2020 or,
Yeah,
Yep.
that's the last year they'll have the payment on that.
okay, so like that one's going away next year. Yes, dear.
Aaron, would it be useful to know for the loans what the interest rate is?
You're asking me?
Well, it's sort of interesting, I think, just to know what we're paying as an interest rates on these things.
Is there the loan, if you open up the fourth quarter budget report, there's a loan sheet and that has the interest rate. But most of those don't have any interest or admin fee because those revolving loans are all
Or 0%.
are all zeros. It's the Jericho Road bond and the Millet bond that has interest, and the phosphorus.
And that's why I think it'd be interesting, is people sometimes get concerned you're borrowing money, but you realize if it's 0% interest, you're actually paying it at lower rates over time.
Yeah.
Column F.
So this is in the debt schedule that we provide every quarter. And so the highlighted column there shows the percentage. So there are a couple, but like what? The East Main Street I think doesn't have interest. If there's nothing there, there's no interest in, I guess, right?
East Main, zero.
Everything's zero except for the top two, I think.
Yep.
But they all came through with a subsidy or 0% interest or a little bit of both.
And the water tank one went away this year, so that's done.
I think part of what you're asking is, could we add that to like a parentheses on the budget somehow? So
You know,
I don't think we've ever seen that.
oh, it's in the packet every year, every week. We don't spend a lot of time on it. Not every week, every quarter. We haven't ever spent a ton of
All
time
the
on
cool
it.
people look at it.
I feel like I open all the attachments and I don't feel like
Sure,
I've seen that before.
It's one of the tabs in the spreadsheet.
No, I separated that. I do it separate. Because it's so big. I condense the spreadsheet to a PDF and then I add the debt schedule here as an Excel sheet. So yeah, I mean, we can. start
Maybe
looking
I look
it,
at the
but-
one, the PDF.
Yeah, the PDF, but then I always add the debt schedule separate.
Okay, I think
but-
I look at the PDF then, maybe not.
And
the-
that doesn't have the debt schedule,
Excel.
because the debt
Okay.
schedule is so, it's like
Yeah,
forever long, that it would be terrible on PDF.
So to Josh's question, would it be useful? I think it would to have in this section of the debt section, wherever in addition to the year that it will be complete, to include percent, even if zero. Just because I really like how simple and clean this is. You know, there's a lot in a couple of pages.
arguably. The two that say interest underneath are the two that have interest.
Well, and then
Well-
and water debt,
But you don't know what it
The
is.
0%, okay.
so 0%. Or what was up there, 1.91% or something? Was that? Maybe I'm.
Cause like the water reserve has interest and the Jericho on the water one. Well, yeah, we could do it.
That was, yeah.
Hey, someone that's not us, don't look at it.
3.83.
They're still
Something.
arguably
Yeah.
low interest. I mean, 1.91, it's like buying a
Yeah,
car, like, please buy my car.
yeah.
Now Jericho Road is interesting because that's split with highway. So it's a 48-52 split between highway and water, and then it's a 56-44 split between water and wastewater.
Yeah,
That's super easy. Come
but
on.
still, our percentage is 3.8 and change on both sides of it, so you can add that in.
I think it would be, just because it puts a little more in this one thing, but I find it really useful to see, oh, when do we pay these off?
I like
Yeah.
that.
And then the percentage, I think, is the other perhaps missing piece of information. that
And-
kind of wait on.
We're gonna lose one of the things with interest according to this, cause it's done in 2025. So we will just have the Jericho Road one that has interest.
But that's also why the fire protection revenue went down.
Oh,
Right.
Look at this part,
cause the gap loan is gone.
you
Yep.
got,
Right.
I did not
So-
put those together, but now,
we'll make this rather large, but yeah, so it was 48% of the tank loan, which is $37,000 this year. And the gap loan is 0, so that's why that dropped by quite a bit.
well, does anyone have any more questions or do you want to get done a half hour early?
Actually, we're supposed to finish at 7:35.
We're like
I
surprisingly,
thought it was till 8.
Well, if you look at the times on the agenda.
I made it till 8, but I said 45 minutes per was probably about right. It looks like.
Hey, don't tell my family I'm hanging out alone for a half hour in my car.
You can stay in here if you want.
Well, we could just watch the Windows updates we do. If we, Duncan was saying we need to do the window updates, so
Did you put that in the chat or something?
he said it at the beginning.
Okay.
But there, you see that little red dot on the toolbar?
Yeah, we
You
could,
click, you right click on that and we can just sit here and watch that.
we could do
No,
that.
that's okay.
That could be a fun
Keeping an
time.
eye on it, making sure it's
Yeah,
happening.
I was thinking I was skipping bedtime.
So when do we pick this up again?
This up in 2 meetings on April 7th.
Okay.
Cause next meeting, we're gonna wait for the data, right?
We'll have an update on the water
Gotcha.
leak next week, and then on April 7th, we'll have some more feedback from Steve. We'll have the water usage, we'll have sample rates. We should have more to talk about then.
And if Steve, anything about the break, has he texted you?
No, I'll text him, see how it's going. You can go up there. Have a show.
Good, yeah.
Motion.
I'm pretty good at that.
Second,
Okay, hearing the motion, is there any further comments or reasons why we don't accept the motion? Hearing none, we'll take that to a vote.
All right.
Jay,
Aaron, aye. Thank you, Connie. I should have said that before. Thank you for joining us in
You're
person
welcome.
for this meeting.